Hello, everyone.
Just 1 minute, Ranjit.
Okay.
You're starting the recording.
Okay, let me know.
Okay, we're ready to go.
Hey, good afternoon, everyone. Welcome to Property Professionals. Today, I'd like to welcome one of our regular guests on the program, Arif Panjani. Just a little bit of a reminder again of his background. He's a co-founder and partner of MapPlus, which is an award-winning firm of chartered accountants. He's got a double bachelor's degree in applied accounting, and he's also a member of 5 other professional bodies, including Chartered and the Chartered Institute of Public Finance and Accounting Technicians. He's further specialized in property tax specialization and assisted both the UK and foreign nationals in building and sustaining their property portfolio in the most tax efficient manner. He sits on the Association of Taxation Technicians Technical VAT Subcommittee to share his knowledge. He's made appearances on television and is also a seasoned speaker at various conferences and business forums. Today, we're going to be talking about the impact of the implications of the Autumn Statement on property investors. So thank you for joining us, Arif.
Hi, Arif, you're muted.
Yes, yeah, I can hear you guys. Thank you very much. Thanks a lot. Am I okay to go? Or perhaps there was a mortgage update, isn't it? That goes normally before me.
No, you're
if
ready
not,
to go.
then okay. If I can just, I'm not allowed to share the screen, it seems. Could you allow?
We get that arranged. I think you can share the screen now.
Let me try. No, not yet.
No. What's going on? Usual participants.
Yeah, it's now.
Okay.
On now. Okay. Can we all view my screen? Okay, it's all okay.
Right. Yep.
Yes.
Okay.
Yes.
So like I mentioned to Srinda earlier, apologies that I'm not that well and my throat may not sound that good, but I'll try and do whatever justice I can to the slot that I have been given. We already did cover some of the budget aspect as to what was changed prior to this further amendment. So this is technically the second amendment to what was earlier been announced on 23rd of September, then amended on 3rd of October, to also further amended on 17th of November. But rather than going into again all the details of it, which I already covered, I would just highlight the points as to what us as a property entrepreneur, whether investor, developer, or anyone in between really affects us, which areas of taxes could affect us, and what we can do to mitigate them forward. So let's crack on with it. Obviously, the introduction has been given. I would not waste much of my time, apart from the fact that I am also a property investor and entrepreneur. So while at the same time, I look my clients in terms of the fact that they are our clients and they are property entrepreneurs, I also try to step into their shoes to see how painful it can be, particularly from the tax perspective, and why it is so vital, never than now, to be more compliant and to be more alert in around the property tax planning. So let's look into just the bullet points of what further changes has been affecting, and I will start with the income tax. Basic rate band, that will remain 20% indefinitely for now, and the band would remain as it is. Now, before, I mean, the impact of this doesn't sound that as it is. I mean, because it looks like it would remain as it is. There is no change in it, but that's what the lethal part is. So with any tax, you have a threshold. Say, for example, up to first 10,000 pounds, you don't pay anything, and then thereafter you start paying tax. Now, this threshold needs to get increased every year, or at least in line with the retail price index inflation rate, so that your taxable threshold, once it increased, you would pay lesser tax. By freezing the threshold, it is not aligning with the retail price index inflation rate. That means as the time passes, and unless this gets changed, the number one, you are effectively indirectly paying more taxes. So if the basic rate band would remain as it is, which is currently about circa 50K, give or take, 3 years down the line, if this were to remain as it is, then it should have been somewhere in the range of 55 as opposed to 50. So on that non-increment that has occurred, we are effectively paying more tax, if it makes sense. The additional rate band, and this was the major chunk why the earlier budget of Liz Truss and the Chancellor earlier got bounced back again. The fact that they were planning to abolish before that, before the earlier budget, it was 45% rate. The mini budget abolished it, stating the fact that there should not be any additional rate band at all whatsoever. So you just have a normal rate, which is 20%, and the higher rate of 40%. They abolished 45% completely. To what we have now, again, is to put back 45%. But not only that, the most lethal part is that from 150K, it has gone down to 125K, i.e., you could have been subject to 45% tax if your income were to be over 150. So if I were to earn 170, only the last 20K would be subject to income tax of higher rate of 45%, but now it is 125K. So us as a property entrepreneur is coming, the gap is closing more and more narrow rather than wider. So from basic rate band of 50K to not only just the higher, but additional rate band of 125K, there's not much gap there. Hardly 75K for the entire year. And if you have a gross rental income, particularly, especially when you cannot even deduct the mortgage cost against Section 24 and all, we all know that the gap would get narrowed down and eventually will be all more trapped into paying more taxes. So this, I believe, from the lethal side of it, yes, 125K is a straight away 25K gap, 25K cut to make 45% more. So effectively, if you were to work it out that way, yes, I would say anybody earning more than 100K should review it, because once you go above the 100K bracket, you would also start getting lesser of your personal allowance. So you would not be able to get your first threshold of 12,500 that you would get otherwise. But that's a discussion for some other time. The dividend rate, what was announced before was increment. The mini budget reduced it, and what we have again back to what it was before. However, the other side, which is more important. So what I meant by that is it was 7.5%. The mini budget said it was 8.5. Mini budget said 7.5. Now it is gone back to 8.5. It's just a joke, really. But what the difficult part that I'm about to say now is the dividend allowance. So dividend allowance currently is £5,000, i.e., it was £5,000. Currently, it is £2,000, i.e., anyone earning up to £2,000 would not be paying any dividend tax. If you were to withdraw more than £2,000, then you would start paying dividend tax, which is 7.5% effectively. That would go down to 1,000 from next year, 6th of April, and would get further reduced to 500 from 6th of April 2024. Effectively, as good as you would say that every single penny of dividend that you receive in the next less than 2 years' time, you would start paying 7.5% of tax minimum if you're basic rate band, and 32.5% if you're high rate band. Now, why it affects us as a property entrepreneur? Because majority of us have formed limited companies, and we have got withdrawals that we take from the limited company. And if you were to do so, then that would be subject to dividend tax. And that is where we need to be more vigilant around, as to the fact that the withdrawings that we are doing from the company should be treated as a dividend, or rather should be treated as a director's loan reimbursement, so that we do not pay that much amount of dividend tax. That's onto that. The national insurance contribution, that's some sort of kind of good news. There's an increase in national insurance threshold. So again, which I've mentioned earlier, that there is no increment in the basic rate band, but there's an increment in the national insurance contribution thresholds. That's kind of good news, because all of us would be on the payroll of our own company as well. Or even if you're self-employed, then we would pay national insurance accordingly. So that would have some relief side of it. But above all, comes the capital gains tax, and this is primarily affecting those of us who've been owning properties individually. And this is primarily for residential landlords owning individual properties. Again, there's a word called annual exemption. The same application of what I've explained earlier in terms of thresholds. The first £12,300 doesn't get subject to any capital gains tax. If your gain were to be more than 12,300, only then you would start paying the capital gains tax, depending on what you have sold. Now, that threshold would get reduced to £6,000, which is almost 50% lesser, or in fact more than 50% less in the next 5 months or so, from 6th of April 2023. And from 24, it is going to be 3K. Now, given the current market and given the fact that there's an increment in the mortgage cost and the interest rates, those are the landlords who would like to retire or perhaps thinking of retiring it would have thought, let me sell it. And or if you have to sell the property because of the fact that it's not making the cost benefit analysis, not making business sense for you to hold those properties, you would be paying comparatively more capital gains tax as opposed to what you would have paid otherwise. So if you want to sell, ideally I would say sell it before the next 6th of April 2023, by which you would have half of the annual exemption. And plan according to the fact that if you own the property just under your name, and if you're married, it doesn't make any sense to just sell it under yourself. Give at least half to your spouse, so that then the annual exemption gets spread across. You get double the annual exemption and your capital gains tax reduced. But this would be a major one, and this would result into lots of capital gains tax, not only just in terms of filing it, but also in terms of HMRC inquiries. Because capital gains tax used to be part of the self-assessment, but it's no longer now. And once you've sold anything, let alone a property, you have to report and file it to HMRC within 60 days. That's within 60 days from the end of the month in which you have done the transaction for. Earlier it should be 30 days, but then HMRC realized it's just too short notice for the taxpayers to file and pay. So it's now 60 days, which is a very short notice. But as it is, it's there. But yeah, unfortunate really. So let alone in terms of what I have discussed, the number 3 and number 5 itself would give the HMRC, expected to get HMRC over 1.2 billion in the next year itself. And number 3, which I mentioned, was the dividend. So by reducing the dividend threshold to about 1,500, and by reducing the threshold for the capital gains tax annual exemption to about 6K and 3K, they're expecting 1.2 billion a year. And I would not be surprised with that figure. Yes, it would, and it should, because I can clearly see coming next year many landlords who were even serious landlords before, but now have thought maybe it's not worth the game now, or perhaps those who had higher leverages on their properties decide to go outside the property market and do something else. There I can clearly see a huge amount of capital gains tax liability into the HMRC's pocket. And we are talking huge amount here. I mean, 28% is the capital gains tax on residential property. 28%, almost equivalent to almost like 1/3 of the gain that you would sell. That's quite huge figure. Number 6, inheritance tax threshold remain the same. Again, all these thresholds which keep on remaining the same means more bad news, because as the time passes, the value of the property would go up. The 40% rate would remain as it is. That means you're going to pay more tax. It's like a silent killer. You don't realize it, but it's there, because threshold has been frozen, and it has been frozen since 2009. It's not even a joke, really. It's beyond a joke, because if you were to buy a property back in 2009 and you're not going anywhere near South Kensington or Chelsea, any property that if you were to go for, say the property value was 250K back in 2009, what the estimated value would be of that particular property in 2028. Now, any increment that property has seen from 250K to God knows, maybe $1 million or whatever, any increment property has seen, HMRC has sweetly taken 40% of it if we haven't done anything about it. Some changes onto the corporation tax as well. Previously, we had only 19%. Now it has changed. It will continue to change, which means that, yes, it is 19% only provided your profits up to 50K. If you're making more profits, that can gradually go up to 25%. So if you have a profit of 250k or more, your corporation tax rate would not be same as somebody who's making the profits of 30k or more, 30k or less rather. So yes, there'll be a change, but please don't do any DIY tax planning about. You say, oh, I've got a profit of 200k. What I would do is I would form 4 companies in which then I would have 50k profits for each company. But clearly it's called the anti-avoidance legislation to trap it. And don't do that, because again, amongst all the 4 companies, it will be yourself shareholder, the actor, or perhaps one company owning the other company as part of the group structure, which will negate what you're planning to do. Capital allowance, it was allowed super deduction in the COVID budget period. That is still there up until April 2023. So if any of us are planning to buy onto some investment properties, or even those investments within the property, which the benefits of which would last you more than a couple of years, then I would say do that before April 2023, because it would last thereafter. I.e., any amount that you spend, say for example, if you were to spend £100, you would get deduction for £130. That's what the super allowance, super deduction was for the capital allowance. It would stop from April 2023. So that is something to look forward to. But again, rather than going into the hazards of what the budget is and what bad news are, I always concentrate on the fact that what we can do as a property entrepreneur and what we can do to mitigate our taxes. And just to sum things up, portfolio incorporation is still lucrative for anybody who own more than 5 properties. But again, there is no benchmark as such in terms of number of 5. This is usually give or take. The benchmark is 20 hours or more if you were to spend, or your agent spends on your behalf to manage the properties. It's a no-brainer. Still, you should incorporate a property portfolio. With that comes twofold advantages. Number one is your capital gains tax, because the properties get uplifted to the new market value. And number two, yes, by obvious means, you award the Section 24, which means you can deduct your mortgage cost under your company, but you cannot under individual or any other structure that you want to have. Now, for those who own lesser than 5 properties, and I would say even for 1 or 2 properties, you should go ahead with the limited liability partnership structure, though it is not as lucrative as the portfolio incorporation. But at the same time, the least this does is that it does make sure that you don't get affected by Section 24. So you have the full flexibility of how much amount of profits, once the partnership LLP has decided and accounted for, how much you can transfer into your own company and how much you can transfer into your own individual side of it. So you can always limit up to the basic rate band, whereby you are not affected by Section 24 thereafter. Then comes the stamp duty, land tax refunds. It's always important to look at the fact that what you bought, could that be subject to some refunds on it? Typical example that I gave is that if you were to buy a probate property, would you be surprised to know that there is no stamp duty, land tax on buying a probate property? So these are just some of the examples of being aware of the fact that there are legislation to be aware of that can be benefited to us. Now, stamp duty itself on £500,000 worth of property could be in the range of £35,000. Now, these are huge chunks. If you just be aware of it and take actions prior to going for those transactions as opposed to post, because getting refund is always difficult from anybody, let alone HMRC. But making sure that you file appropriate taxes so that you say zero stamp duty land tax makes more sense. Then the capital allowances on the commercial property, and this applies to more of the care homes and the hoteliers, but also any of the commercial property as well, even if the shops and the uppers. If there are some commercial investments within the property that comes as part of the deal, then you can claim significant capital allowance when you buy those properties. And this ranges in the range of about 18 to 20%. So imagine if you were to buy a property worth £500,000 and you could claim capital allowance of 80k or 90k, all of that amount could come handy. And last but not the least, for those who are wishing to buy more properties, whether residential or commercial, and they intend to buy under company name, I would recommend go for smarter company or freezer share structure, as opposed to just a standard off-the-shelf company. Because with the freezer share structure, you get the advantages of freezing the value of the property for the purpose of inheritance tax and many other side of it. So yeah, I hope I have justified your time. Feel free to ask me any questions, and the QR code is there. An apology once again for my throat infection, as I'm not that well today. Open to questions if you have any.
Yes, Chiranjit, you're muted. Do you have any questions for Arif?
Yes, thank you, Arif. That was a really great summary, and yeah, it's really interesting, isn't it, to reflect on how actually tax, it's very hidden, isn't it? Like you said, the basic rate tax, it's by keeping it still, actually, our allowance is being eroded. That's very interesting. One question I also did want to ask you, and I can't remember now, I've heard this, or whether I've heard this correctly, but where somebody's say lost their job, is there something where the government's going to come in and help you, like support you by paying your mortgage, or there's some kind of I heard something in the rules which says that they're going to provide some kind of support, so if people lose their job, or they can't pay their mortgage?
I'm not saying apology. I'm not saying that they could not be. I don't know. I'm not aware of it. It's not something
You're not
that
aware
I've
of that?
heard of.
Okay.
No. But again, this is very generic as opposed to just specific to property tax planning. But if you have
Okay.
lost your job, would government support you in what way?
In giving you mortgage support,
Mortgage support.
giving you sort of some benefit to cover your mortgage payments. I mean, do they do that already?
I've not heard of it. I'm aware of these employment protection insurances, I believe. And I guess you have to have some insurance, but whether government supports it if you were to lose a job,
Yeah.
I'm not too sure.
I believe that is the case, but it's
Yeah.
deferred, and they only pay interest and not the capital.
Yeah.
counter.
That's right. That's, I think, what I was talking about. So was that something new that was brought in, Surinder, or is that?
No, that's existed from time immemorial, really. It's always been carrying on. So
Okay.
if you lose your job and you go onto your benefits, then you could potentially benefit from that.
Right. Okay. So given all that, Arif, what do you think is going to be like the effect on the property market for next year?
I mean, it's just a matter of everyone's opinion, isn't it, in terms of property market? We can all see the property market as it is. The market is not as hot it used to be same year last time. But yeah, I mean, for the next few years, I can see less of transaction in terms of buying and selling, certainly for sure. We've all seen the hit in the interest rates, and the mortgage cost has gone up, skyrocketed. So that has to get into the consideration, the fact that, if you're planning to buy the properties, I would go and buy those distressed sale transactions in the properties where I can make immediate profits at the very outset. Those who are selling it for a reason as to A, they can't afford, or B, it's not making any sense for them as a property business side of it, and so on and so forth. But also in terms of rental, so you also look at the positive side as well. So if you have a couple of buy-to-lets, perhaps next year is the time to review your rents and say the fact that, I'm sorry, but the rent would go up. And if the tenants were to say no, then you should be of no limitations of going for the new tenants, because there'll be more tenants in the market as opposed to more buyers and landlords in the market. So looking at both the sides. But yeah, I mean, I think it's the buyer's market for the next year at least, especially for those who have cash. And at times, I mean, you would be surprised, but some of my clients wait for these times, such as COVID times. Well, COVID times, everybody had money because government was generous. But in recession times, other times, they buy properties, they buy investments, they buy businesses, because they know during that time is the time when you definitely buy below market value. And it is by no measurement the fact that you would see the fact that the property price that was there last year, if the price, even if not reduced, has remained the same even for the current year, that means you're buying it for a bargain, because by very default the inflation should hit in and the property price should go up at least by some margin over the years. So yeah.
Right. Okay. This is an interesting point somebody raised to me. If people are advised to buy properties in limited company names, one, for taxation purposes, secondly, for inheritance tax purposes. But don't you think it's the same effect in inheritance that they might inherit a property or property shares, company shares, which would be liable for inheritance tax as well?
Yes, I mean, it doesn't negate the fact that you're buying the property under company name as opposed to individual name. That means now you're not going to pay inheritance tax. Of course not. But if you buy a property under company name and the company happens to be a smarter company, which is freezing the share structure, that means any increment in the value that property would see from now till the time of your death would not be subject to inheritance tax. That's what I meant. So if you were to buy a property worth 500,000, say mortgage free to make life easier, and then by the time you died, it was worth 800. The property would be subject to inheritance tax, but only on 500,000, not on the increment of 300K. That's what I meant. But if you
Okay.
were to buy the property under your own name outrightly or jointly with somebody, then the entire value would be subject to inheritance tax because that's what the estate value would be, 800K at the time of death. So that's the
Okay.
main advantage of going
Right.
through the smarter company structures. And
Okay,
so
you talk about smarter company. Can you briefly outline what you consider to be a smarter company?
So when I say smart company is just a name in term. In essence, what happens in the background is that you freezes the shares. So shares gets issued in terms of two types. You have Class A and Class B. Class A is for the existing value of the property as it is. Class B is for any increment that particular property would see in future. And you could assign beneficiaries. Obviously, you need to have trust in place, and there's a lot of documentation in the background that goes in. Alongside the legal documentations as well. But then you can define the beneficiaries who could be benefited from Class B shares. Now, since there are different set of beneficiaries defined already for the Class B shares, and that's the reason if you were to die and the value were to be 800K, what you own was just Class A shares, and Class A share was 500,000 only,
Right.
because Class B shares were never owned by you.
Mhm.
And then it's not just a matter of, oh, I've got a property, I'll just transfer. Oh, I've got shares, I'll just transfer to my son. No, it doesn't work that way, because if you transfer, any transfer triggers capital gains tax and stamp duty land tax at least. But here, you're not transferring anything, because at the very outset, you are transferring it, but the value is zero, because you're transferring the increment in the value. And the value has not increased when you've bought the property. I mean, it's not the fact that you bought the property and the very next day you're going to, from 500,000 pounds to you get 1 million. No, it's not an antique whereby you can reassess and reascertain the valuation. No. So it's a very smart way. That's why it's called smart company stock. It's a very smart way of mitigating inheritance tax in future.
Right. Okay. But but there have to be named beneficiary, a trust created for the benefit.
So yeah, I mean, like I said, there's about 9 to 10 legal documentation that goes in the bank now, and you get HMRC clearance on it,
Right.
and all of that get reported in the company house. So that, of course, on that, HMRC is not going to easily let go of 300K times 40%, 120K worth of inheritance tax. So you have to have some solid documentations to approve it by. Yeah, I mean, always when you do these kind of works, always get your professional clearance upfront, and make sure that your professional advisor has got sufficient professional indemnity insurance, so that tomorrow something goes wrong, you can claim on the indemnity insurance.
Sure. June has a question. June, would you like to ask that, or do you want me to ask it for you? Hello, June?
Hello, sorry, I was to unmute myself. I've got three questions, but the first one is, I have my father's house, it's in his name, but I'm his executor. And I have a buyer, which is taking forever and a day. But once I get the money from the buyer and I split it among my beneficiary people, will I have to pay capital gains before or after I split the money? And I was told because of the conditions, I wouldn't have to pay capital gain. When don't I have to pay capital gains tax?
Okay, now before I start answering these questions, so I've always mentioned that scenario specific questions which are pertaining to your own personal tax matters, I'm barred from providing the advisory service by the regulatory bodies. I'm more than happy to answer any generic questions such as Surinda has asked
Yeah,
or
yeah, but
Charanjit
that
has asked,
is,
but
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 it
I
is
cannot
to do
answer
with
the
me.
specific. Yeah, so
No, but it
because
is
I'm
to
barred.
do with me because of the fact that I'm selling my father's house, and I got a feeling everybody kept going on about capital gains tax. I still don't understand what that means, because somebody says, I told them my situation, I don't have to pay it, but I'm not sure. Because it's not in my name, I don't know how capital gain tax works. That's
Okay, Arif, can we create, well, I'll create this as a generic question.
yeah,
A
I'll make
person,
it a generic. So what I would say is obviously this is something specific, because
Yeah.
last thing we want is we have advised, the
sure,
client has taken the action,
Mm.
and the action is not as per the advice, or the advice is not appropriate,
Mm.
and then it goes to
Sure.
the indemnity insurance dilemma. So
okay,
just to
Okay.
make life very easy, if someone were to die, then the inheritance tax computation is to be done. So clearly,
Yeah.
it seems like we haven't done it, and you need to go through the probate process first. That's the first step. Once you've gone through with the probate process, the first stage is the inheritance tax computation that goes in. Then thereafter, what goes in is the fact that if you were to sell the property, then you would do the capital gains tax computation.
All right, okay.
Okay, that's in essence.
Because I
So
know
again-
I know I don't have to pay inheritance tax because the house did not come up to the 600,000 margin. But it was a little bit over the
but you-
325 benchmark, but it didn't come under the 600,000 margin. So I don't
June-
have to pay inheritance tax.
June, the first question is, was there a probate done?
Yes, yes.
Okay, fine.
Everything
So
was
that's
done.
it then. So if the probate is done, then the question does not even arise of the fact that whether inheritance tax
Because
is
it
due or
can-
not. If the
Yeah.
probate is done, then
Yeah.
the property has been transferred. You got the grant of probate, then you are prepared to sell, and then you're okay to sell. That's it. And then if you have sold the property, then you would file, the executor would file the capital gains tax again. Simple as it is.
Oh, right.
But there's nothing called 600K mark, as you mentioned. But I would
Okay.
rather not go into the nitty-gritty of it.
Oh, right, okay. The other question I have is, if you have, say like 20 plus properties, how does the tax work on that situation?
I don't know anybody can answer that question. So Surinder, do you want to answer that question? If you
Well,
have 20 plus
June,
properties?
Well, no,
First-
I was thinking about estate and wealth planning more than anything else. Who would I have to see or anything like that?
So again, what I would recommend is that first thing first, when we see client, is what we ask for is the property schedule. So portfolio of the properties
Oh,
that
right.
has got everything starting from how much they purchased for to what the market value is, what the mortgage outstanding,
Oh,
what your
right.
rental income is, and so on and so forth.
Okay.
And then from there, we start with the fact that, okay, what we start is the worst case scenario now. So God forbid, if you were to die now, what the inheritance tax liability would be.
Oh, right.
And that would only go up and not go down from the
Okay.
time you actually die, because
Okay.
the property value would highly likely go up.
Yeah.
So that's what the starting point is. But yeah,
June, let
just
me
to
ask
look
you a
into more
question.
in detail.
Do you
Yeah.
have 20 properties at the moment?
No, that's the
Your
goal.
plan. So
That's the
why-
goal. That's the goal.
So
That's
that,
the goal.
so it is your question is you should see a state planner like Arif now to
Yeah.
for him to tell, you can discuss your situation with him, personal situation, and he
Yeah.
can advise you as to which direction to go to
Yeah.
mitigate.
Well, that's
the
what I
future
wanted.
tax.
Yeah, that's what I wanted to know.
Yeah.
Okay.
So you have Arif here who you can contact. You have his details on the screen. You can take them
Yeah.
down.
Yeah, I've written them down.
Yeah, and you can contact him, have a
Yeah.
session with him, and
Okay.
then you know where you are, and where
Yeah.
you want to go.
Yeah, yeah.
And how and Arif will probably during that conversation with you show you the way
Yeah.
to get there with mitigating a lot of tax.
Okay, thanks.
Okay. Okay, Charanjit, any
Sunita,
more?
Apology. I'm just about to go for my, I think anyways, but I'm obviously not feeling that well, and throat was
Okay.
not that great.
Well,
But yeah, I mean,
Well, we're very
for
grateful to
question,
you
hopefully.
for coming on, although you're not well. And thank you very much indeed.
Apologies.
And it was
Yeah.
a very, very useful session. Charanjit, anything to add?
Yeah, no, that's fine. Thank you very much, Ruth. That was really enlightening. It really made
Thank
up.
you.
So thank you very much
Yeah.
for joining us despite feeling unwell.
Thank you for Ed and June for coming along. And we shall see you next week.
Yeah,
Thank you.
very much.
Thanks.
Okay. Thank
Bye-bye.
you very much. Bye, everybody. See you.